You know how to do, yeah, Parker knows how to do that.
Okay. Well,
Okay.
we'll start that.
Okay, that's easy. Okay, there you, yep, there we go. You're the host.
Okay.
You should be able to share your screen.
Yeah. So I'm going to be the host, start the video. All right. For some reason, it's not allowing us to do it. What, Parker, do you need? Do you need to ask Chris anything?
I just made you the host again. So you're the, for some reason you switched me back to the host. There you go. All right.
I got the video on.
Okay. So then you have something you need to share on your computer or?
Yeah, let me bring this up.
Okay. And we'll start with Larry Lucky Jeans after I open it up.
Okay, I got to go find out where it's in my,
It's down on the bottom. It's a PDF.
yeah. I don't know if it's going to be under more there. It's going to be the PDF I just brought up.
Exit full screen view. Okay, then go down here at the bottom.
Let me see here, Chris.
Yep, that's it right there.
Okay, got it. Can you see that?
Nope. You got to share it.
We got to share it. Hold on.
Here, I'll
Right down at the bottom, there's a little green button that says share screen.
Okay, hold on. Just pulling it up.
It's not showing the buttons.
Right here, share screen.
Mm-hmm. And then you just got to select the screen you want to share.
Okay, there we go.
And you're gonna have to go back and press share computer sound.
There. Okay. Is that
All
it?
right. Yeah, you got that?
Yep. Larry Lucky Jeans. And then you
All
just
right.
gotta change me back to the host. So just click
Okay.
on my name at the top. Click
Change Chris
more.
back to the host. You got it? Did that work, Chris?
I believe so. Let's see. Yeah, that should, I can't tell from here, but
Okay, but anyway, so you can see the screen and hear my voice, right?
yes, we're good to go. All right. So I'll open it up. Sorry about that, folks. Technology is a thing. All right. You ready to go, Brent?
I'm ready, man.
All right. Welcome everybody to the last of a 6-part series, the Wealth Webinar series that me and Brent put on, or Brent and I put on would be the right way to say that, to teach you guys all about infinite banking, all about the money multiplier, and how you can become the bank. It's been an awesome 5-week series, or actually it's a 6-week series, but we're on the 6th week. It's just been phenomenal. The questions have been awesome. I've been getting countless emails and text and direct messages pouring in with people that are saying how much they love this series. And that makes us feel really good because we've never done a full series like this. We've never done this much stuff all in one series. So we're going to actually have all this recorded, and we're going to eventually put this up on Money School TV so that all the members can watch this. And any of you that have been part of any of the 6-part series, I don't care if you were part of 1 or only 6, you will get all of the recordings emailed to you. So you have the entire series of what we've been teaching. And, you know, today, this one's kind of the one we've been really, really waiting for. We're probably more excited about this. This is the one where we're going to go over the FAQs, the facts and the questions. That's the thing. I have people emailing me questions of things that they want to know. So and then I've even had people messaging me say, hey, they have to go to the hospital. They can't be on, but here's their questions. So I think today is going to be just off the charts. But before we get into the Q&A, I want to go over some housekeeping. First and foremost, all of you have the ability to chat in your questions, or you can so there's a Q&A. You can click the Q&A on Zoom right down at the bottom, okay? And you can put your questions in there, or there's a chat. You can chat in your questions, and I will try to get to each and every single question throughout this series as we get rolling. Brent's going to open it up and go over something that we weren't able to get last time, and it's Larry Lucky Jeans. This is a great illustration, a great example, and I want him to show this. And then at the end, if we have time, which we may not, depending on how many questions you have, I have a special presentation that I put together for my new daughter that was just born. She's about, what is she today? 9 days old today. Not even a full 9 days, but I've got something I set up and I want to show that if we have time. If not, we'll do it on another series of the Wealth Wednesday. So Brent, you can take it over from there.
All right. Fantastic, Chris. Great to be on. So sorry about that technical difficulty in the beginning, but we got it all worked out. So yeah, most of today is going to kind of build up on the last 5 that we've done, the last 5 Wednesdays. And today's going to mainly be a Q&A, a question and answer. And I know, Chris, you have a ton of questions that people have called in, texted in, emailed in, things like that. So we'll go through, and then hopefully, as we're going through this on the chat box, people will ask questions based on what we've done for the last 5 weeks. And if you haven't watched the last 5, I would suggest that you go back and start with number 1 and go all the way 1, 2, 3, 4, and 5. And then this is number 6, because they each will start to build on each other. Okay, so this one here is called Larry Lucky Jeans. Now, this is not a typical policy the way that we normally would design a policy. This is a 10-pay participating whole life policy. And again, this is just an example, okay? And so this particular one is with a company called Ohio National. And as you know, if you're working with Chris and I, you're going to write with like one of 5 different companies. We've given you, I think, examples of every company that we work with over the last 5 weeks. And this is just one with Ohio National. Now, it doesn't mean you have to use the insurance company, Ohio National, to do this. But again, this is just, okay, the one that they call the Prestige 10-pay. Now, so the reason I say that normally when we design the policy, it's not a 10-pay because, okay, just because of what we teach, we always teach people to pay their premiums always, to always pay their premium. You never, ever, ever want to stop paying your premium into the policy. But every now and then somebody will say, hey, I want to just to pay this thing for 10 years and be done with it, 20 years and be done with it. And let's just go through it and see this example of how this individual used the policy. So if you notice, we started this policy on a child. Up there on the right, it says their age 1. Okay. And what we're going to do is we're going to pay premium into this policy for 10 years. Now, this is a common policy that as far as that maybe a grandparent will start on a grandchild or a parent will start on a child. So again, they're starting off at the bat. And I think, Chris, this is similar to maybe what you may show and what you may be doing with your new 9-year-old daughter, but probably with yours, you're going to always pay the premium. You're not going to stop it after 10 years. But this would be an example of what you could do. So if you notice on the left, it has the years, year 1 to 5, 6 to 10, 11 to 15, and so on. And it also has the premium that they're going to put into this policy. And in this case, it's going to be $15,000 a year in premium, and they're going to pay it for 10 years and stop paying the premium. So if you notice the next column over where it says the cumulative premium, it goes 15, 30, 45, 60, and so on. And if you notice at year 10, it gets to 150,000 and it stops. So that means they're paying 10 years at $15,000 a year for a total of 150,000. All right. And then you have the cash value in the policy. All right. And then over on the right, you have the net. It's going to be what the death benefit is on this particular policy. So I don't want you to get too wrapped up in the weeds with the numbers. I just want you to get the concept of exactly what's going on here in the policy. And remember, all right, these policies, just whenever you're starting them, you're not starting them for short term, you're doing them for the long term play. I tell people, I just had a conversation with someone earlier today that a question was, well, how about if I decide to pay premium for just 3 or 4 years and then I don't want to pay premium anymore? So anyway, my answer is don't even start. Then just don't even start. Just throw away all the material that you have and walk away. You're not going to be happy if you're only going to want to put in premium for 2, 3, 4 years or so and stop. So I just tell you not to even start. Okay, if you notice here in this policy, let's go out to year 18, right? So I guess it's the 17th year, age 18. So now what's going to happen is this person is going to go to college because they're 18 years old. So in this example, the thing that we're going to do is we're going to pay $20,000 a year for college, right? So you're going to pay for college in year 1, 20,000, in year 2, or in the second year, which is really going to be, it's going to be the 18th year, the 19th, and the 21st, and the 21st. So they're going to go through 4 years of college, and college tuition is going to be $20,000 a year. Okay? So if you notice here on the 20th year, age 21, they've taken out $80,000 of the money. Can you see right there where it says cumulative cash flow received was $80,000? Okay? So in this policy, they injected $150,000 into it in the first 10 years, and they've taken it out and they've paid for college $20,000 a year for 4 years, a total of $80,000. All right, so life goes on, right? Now we're going to get married at age 25. So how much is the wedding going to cost? Well, it looks like it's going to cost like $30,000 for the wedding. Do they have enough cash in their policy to pay for the wedding? Well, of course they do. Look, they have $201,000 here in the 25th year of this policy. Okay, so now they paid for their college and also their wedding. So they've taken out a total of $110,000 into the policy. All right. Now, if you notice, I'm not paying it back, am I? I'm not paying myself back anything like we teach to do in the banking concept. We're just utilizing this particular policy, this vehicle, to pay for college and to pay for the wedding. Well, after you get married, what happens next? That's right. You want to buy a house. So 5 years later, they come up and they want to put a down payment on the house in 5 years. What did they do for the last 4 years? I guess they rented. All right, I don't know. But now they're going to buy a house and they need the down payment for the house. And the down payment, we're just going to call it like $40,000. Now, all right, is there the whole $40,000 in the policy? Yes. There's $224,000. So I guess if you wanted to make a bigger down payment, you could. Or maybe if you wanted to buy a larger house and just pay for it through the policy, you could do that, right? This is called the infinite banking concept. We can continue to do anything that we want with the policy. So there's so many different examples and scenarios that can be used. All right, so we buy the house at age at age 30 is when we buy the house. And now we continue on with life. All right. And now what happens? Look what happens at age 47. Now, the thing is that you have children and you have college age children. So now what are we going to do? In the 46th year of this policy, how much cash do we have in it? We have $546,000 in cash in year 46. And now we're going to just go and buy college. Well, college, it looks like before it was $20,000 a year and it increased. Now it's $30,000 a year, right? Who knows? It may increase less or more, but it'll probably go up. So now what we're going to do is we're going to take the first child and we're going to pay $30,000 a year for the first 2 years tuition. So now that first child, the oldest child, goes to college for 2 years. But they had a second child, okay? And that second child was 2 years younger. So now we've got one kid that's a junior in college, another one that's a freshman in college because they're 2 years apart. So now this year, in year 48, we've got to pay college for 2 children, which is $30,000 each, for a total of $60,000. So for the next 2 years of this 4-year college, we got to take out $60,000 out of our policy to pay for college. And then if you notice, in year 50 and 51, the first child has already graduated, and now we got to continue to pay for the junior and senior year for the youngest child. So that's another 30 and 30. So what we did right here is between 2 kids, all right, between 2 kids in these 6 years, they were paying $30,000 a year each in college. So $60,000 a year. How much did we take out for the college education? Well, okay, you got 2 kids at $60,000, or no, I'm sorry. You have 2 children at $120,000 each of college tuition over the 4 years, which is $240,000. So look where we're at right here in the 52nd year. All right. The thing that we've done is we paid for college for the first person, which is the parent of these children. We paid for the wedding. We put the down payment on the house. And now the 2 children, okay, the 2 children, we paid for their college. So altogether, up to this point, we have taken out $390,000 of cash flow that's come out of this policy. Remember, how much did we put in? We put in $150,000, right? We put in $15,000 a year for 10 years and stopped paying the premium. But look what happens next. Retirement. We turn age 65, and in this example, that's when they're going to retire, is age 65. I don't know. Are there people still retiring at age 65? Maybe. But in this example, this is when this individual is going to retire, is at age 65. So now they're going to start taking out retirement income from this policy. And what they're going to do is they're going to take out a total of $60,000 of retirement income, $60,000 a year of retirement income from age 65, or from year 65 all the way till the day that they graduate, which we're going to kill them off here at age 90 in the 89th year. So how much did they take in retirement? Well, I guess it's what, 25 years times 60,000. So ever how much that is, add it up. But the total that we've taken out of the policy is what in the 90th year? We've taken out $1.89 million, almost $2 million that we've taken out of the policy. It still has a cash value of $1.1 million. And look at the death benefit. Look at the death benefit, $2.4 million in the 90th year. So I want you to see what it says there in yellow. At the child's age 90, on a total of $150,000 in premiums paid, they have withdrawn almost $1.9 million, which is a tax, which is equivalent to a 7.94% rate of return. Plus, they still have $1,093,000 in cash value and $2.4 million in death benefit. Truly a gift of a lifetime. So that, ladies and gentlemen, is what we call Larry Lucky Jeans. So if you notice the decision that he made, right, or the decision, again, so not that this individual made, but the decision that his parent or grandparent made for him, because at the time when we started, he was only age 1, right? We started this policy on this brand new age 1 baby. Look what we did. We paid for college just for that child. We paid for a wedding for that child. We paid for the down payment of their house. We paid for college for 2 of the children. And we also took out $60,000 a year in retirement income for 25 years. So I don't know of a better vehicle on this planet that allows you to do this with these features and benefits. Now, just imagine, you got to use your imagination. And that's what Nelson Nash always said. He says, use your imagination on these policies. Because the way you can design these things, there's so many ways. It's infinite, hence called the infinite banking concept, right? So could you imagine, let's say if he didn't put in only $15,000 into the policy, what if he put in $30,000 into the policy? What would happen to the numbers, right? What if he didn't stop paying the premium in the 10th year and he continued to pay the premium after 10 years in this policy, okay? Well, how about if he used the cash value? Because if you notice, there's a lot of cash value in here that is just sitting and not being used. How about if he used it for more things that they were doing in life, such as a car, such as paying for their taxes, such as their electric bill, all the products and services that you're going to buy anyway. And if he plays honest banker with himself and he pays himself back, just like he would have had to borrow all right, just from the house on a house loan, or from the school on a school loan, or when they got married, they borrowed, right? They borrowed just to get married. And if they had to borrow money, play honest banker with yourself, just like you would do in real life. What would happen to these numbers? They would be so much bigger. So really, right? So like if I just stand back and take a look at this, so they really did not utilize this policy the way that we teach it to be utilized. Yes, they did stuff with it. Don't get me wrong. This is fantastic. This is great what they did, but there was so much more that they could have done with this policy, right? That's like, to me, this is like having an 8-cylinder car and you're only using 4 of the cylinders. Maybe not even 4, maybe only 2 of them, right? So there's so much more that we could have, that they could have done to make these numbers grow even larger. So, all right, well, that's a policy. It's basically, this is from Larry. It's called Larry Lucky Jeans. And at the bottom down here, this illustration was created. So these numbers were actually created on an Ohio National illustration. And it was run about 3 years ago, not even 3 years ago, 2.5, at October 26th of 2017. And the specifics of the illustration, if you look at the, okay, up here at the top, and again, we just called this guy Larry Lucky Jeans, this new baby. And it was done on a male, age 1, standard, preferred, non-smoker. All right. So again, all companies, all illustrations, they can perform a bit different, but this is just a general idea of how this works. So, all right, Chris, let me throw it back to you, and let's go ahead and get into the question and answer session, if we could.
Absolutely. I think that's a great idea. Do you want to stop sharing your screen and then
Yep,
we'll go right in?
I'll have Parker work on that right now.
Okay, perfect. Well, let's get into this. So at this point, folks, this is where we're going to really answer whatever questions you guys have. Some of you are just joining us. And if you are just joining us for the first time on the 6-week series, no problem. What we're going to be doing is we're going to be editing all of the 6 videos, okay? All 6. And we are going to email them out to each and every single one of you. Whether you've been here since week 1 or you're just joining us in week 6, you're going to get the entire 6-week series, and there's no cost. So we're just going to send that to you, and we're going to email it to each and every single person that's been on here. One thing I've gotten a bunch of people that have asked me, that they have a bunch of friends that want to see this. So when we email this to you, you're welcome to share this with as many friends as you want. The other thing that we're going to do is we're also going to put in there the new video that we have. Now, some people with this concept, they don't have the patience, right? They don't have patience to sit down and actually watch a video that's 90 minutes, that will change their life. So we've created a 23-minute video, which we're also going to give you the link for that. If you have friends that you want to show this to that just, won't watch a 90-minute video to get off the start. So we've got a 23-minute video. We're going to send that. So you're going to get all 6 plus the 23-minute video, and you're going to have all of that. So let's get into the questions. So I've got chats up here and I've got questions up here, and we're going to get into them all. And I appreciate every one of you for joining us. I know there's a bunch of people from the webinar I did Sunday from Duck V. Thank you guys for joining us. Here's one of the questions that came in from Cindy, Brent, and I'm going to direct this one to you. So she had a question for us about laddering policies. How do you do it? When do you do it? And why do you do it? So that's her first question. And then she also has additional questions, which I'll get to in just a second, because she's got, and this is funny, she heard a recommendation from an old retired banker. Interesting that a banker is giving her this recommendation. Banks use this system, folks. That's how they know. And he was advising her to call this agent about this infinite banking policy. But the way he structured it, and this question keeps coming up, he was telling her to do the 90-10 PUA to base and borrow 90 to 95% and then purchase an immediate annuity. I would never suggest doing that, but we're going to cover that one. So why don't we hit the first one about laddering policies, how to do it, when to do it, and why to do it.
Yeah, well, okay, great question. And again, when you say that, I'm assuming when you say ladder policies, you're talking about taking and buying more additional policies.
I think so. Kind of like you have 19, I have 6 of these things.
Yeah. So anyway, there's going to be a time that you are going to have to start additional policies because you're not going to be able to get all of the cash into the one policy that you have. If you're truly going to use this banking concept, recapture, recycle the money the way that we've talked about, you're going to have to start additional policies because the policies have to stay underneath the MEC line, the modified endowment contract line. So I generally start a policy at least once a year because as things keep going and as you get older and you're recapturing and recycling money, your wealth increases. And as your money increases, the thing that you want to do is you got to have a place to put that money. And where better to put your money besides a whole life policy and a mutual company that pays dividends with guaranteed growth rate, right? So the thing we're going to have to do is eventually start more policies because you can't overfill one. And we talked about this previously on the webinars, but it's kind of like trying to get 12 ounces of water in a 10-ounce glass. It just simply will not hold it. So you have to put more dollars into new policies. Now, I don't suggest you starting a second policy until you are, what word am I looking for? You got to be very disciplined with your money and what you're doing with your money. Play honest banker with yourself. If you borrow, pay yourself back the same way you would pay back if you're borrowed from a bank for a car or a house. And also, we got to be careful about the amount of premium that you want to put into the policy because a lot of people say, hey, I got all this extra money I want to put into the premium. But, okay, so then I have to ask them, well, that's fine. If you're going to put the money in the premium now, okay, for this year, you have the money now, but I want to be able to make sure that you can pay your premium just in year 2, year 3, year 4, etc. Right? So I got to be kind of thinking that, okay, so how are you going to get the premium dollars for next year? So those are all things that we'll go over on our strategy call. And so as you're building these policies, you're going to have more, right? As you're building wealth, you're going to have more policies. So you want to continue to start more and additional policies. Now, so there is talk out there sometimes that you'll hear about, okay, well, how about if I borrow a policy to, okay, so like just to start a new policy. If I borrow from an existing policy to start a new policy. Well, let me just caution you on that. Okay. So, like, can you do it? Okay. Yes, you can do it. You can do it because the insurance company is never going to ask you why you want the loan. They're never going to ask you, all right, as far as what you're using the money for. Okay. So it's up to you, right? Because you're in control of what you do. So yes, could you take money from one policy and start another policy? Absolutely. You could do that, right? Can you borrow the premium from your existing policy to pay the premium in your existing policy? Absolutely. You can do that, right? You can use the money for anything that you want just to use it for. But you've got to be careful and you got to be structured and disciplined enough to know what is going on, because the more policies you start, the more premium that you put into these different policies. I need to make sure that you're good for next year, the year after that, the year after that. And I think you will be, no doubt in my mind, but it depends on how you treat it and how you act with the policy. If you're doing what we tell you and you're playing honest banker and you're not, as Nelson Nash says, stealing the peas, then yes, you can do that, but you got to be disciplined. So it's not for everybody. So I just think whoever your coach is or your mentor is on this banking concept, like if it's me, for example, and okay, so I'm going to go through this with you in nauseating detail so you understand what's going to happen, because now you got 2, 3, 4, 5 policies and you're paying premium on each of those. And I just want to outline where those dollars are going to come from. So I don't know. I hope that answered that, Chris, or just unless you want to elaborate any more.
No, I think that was a good answer for it. I mean, basically the laddering is going to be a component of the contributions you want to make to the policies. And, you know, I get people all the time. I tell them I have 6 and they're like, why would you have 6? Well, because one's just not going to be enough. You're going to start one like I did back when I was in a different financial place. I didn't have much money. My first plan I started, I think it was $320 a month. And that was a stretch for me when I started that. But I got that thing. I used it to pay off debt. Once I got that done, then I started funding a second policy with more. So I went from 3 to 500, then 500 and up, and you get the drift. You do keep increasing the amount, not so much because you know, a lot of people think, well, I can only start more policies if I make more money. Not true. We show you how to build wealth through your own debts and expenses. And one of the things I was able to do is I was able to claw back the money, recycle and recapture the money that I used to give away to everybody else. Heck, man, I used to give away tons of money to Visa, to MasterCard, to Lowe's credit cards. I had so many stinking credit cards. I think I could have built a house out of the darn credit cards. But as I paid them off, I took the money I used to pay them and I started redirecting that money into new banking policies. And that's how I did it. And that's how the laddering works. All right. So folks, make sure you guys send in your questions. So here's a question from Jamie. Then we're going to come back to Cindy's question. Can I get a health survey to fill out? So let's see. Can I get a health survey to fill out? And do you flat out deny them forever? Or is it a couple years down the road? For instance, triple bypass surgery. Let's see. Yeah. So basically it's a medical question. So if somebody had triple bypass surgery, how long would it take before they'd be eligible? What would their options be? And do we have like a health survey that we could use for them?
Yeah. So chances are if they had triple bypass surgery, they're probably not going to get approved for the policy. But it doesn't mean they can't do this concept, right? Because the thing you can do is you can own the policy on somebody else that you have a vested interest in. A child, a grandchild, possibly a brother, sister, even a mother, father, depending on age, niece, nephew, right? Or even someone in your business, a business partner. If you go back and do some research, Walmart was buying policies on all of their employees up into 10 or 12 years ago without them even knowing about it. They didn't even know about it, the employees. And so they can still do it, but now they just have to know about it, right? So the policy can be obtained on another individual, and you can use all the tools and the methods Chris and I have been talking about for those policies. So the thing you got to remember is there's 3 things on a policy. There's the owner of the policy, the insured individual, and the beneficiary. Well, the owner and the beneficiary can change at any time. and they can change multiple times, okay? The only thing that cannot change is the insured individual. And normally the owner of the policy is the one that's paying the premium, right? As Nelson Nash says, he who has the gold makes the rules. Yeah, so the owner is the one paying the premium, and they can determine who the beneficiary is going to be. Owner and beneficiary can change multiple times. So yeah, there's going to be times where you're not going to get the policy. The bypass surgery is one of them. We just had one, Chris. I don't know if you were on this one or that just came through, and it was a denial that just came through today. Well, the reason they were denied is because there was multiple DUIs on just on the record. So the question the agent asked me, they said, well, do you think we can try another company since the one, didn't approve it? Well, and I said, probably not. I would not go that route. I would find another body to insure, because the insurance companies don't like it when you have a DUI, especially if it's recent. But then when you're telling them multiple DUIs, it's like, well, all right, well, this guy didn't learn the first or the second time, and he's got multiple ones. So it's more of a higher risk for the insurance company, and they don't want to take that chance, right? Because it's not a right for us to have a privilege, or for us to have a policy. It's a privilege for us to have one of these. So now, I'm not saying just because you had a DUI, you can't get a policy. Don't get me wrong, but they're going to want some time in between the DUI and okay, so in the time you issue the policy. So if you just got a DUI 3, 6, 9 months ago, you're probably not getting approved until you have to go through a waiting period. If you have multiple DUIs, that's probably, I don't know for sure, but it's probably going to be an automatic denial. So there are things that come up like that where you just can't have the policy on that insured individual. But by all means, it does not mean you can't practice everything we're teaching. You just have to find an insurable interest, another body.
So on that medical, I'm going to go one more, and then I got an awesome question from Will. So one other question on the medical side: if someone has a pacemaker, could it be possible for them to get insured? I think the answer is yes on that. But what's your take?
I don't know. I got Terry sitting over there on the other side. Is it possible for pacemaker people? Do you know?
Pretty sure. I think I've done it.
I'm not sure. I don't know. We'll have to check. But yeah. again, so here's what I would do on that. Any questionable items that okay, so like it's kind of not for sure if the person would get approved or not. The thing I would do before I have you go through all the application and all the underwriting process, what we would do is call the insurance company and say, hey, so this potential client here, his age or her age, has a pacemaker. Is it something you'll even consider? And then we ask the insurance company, and then they'll give us either yes, the green light to proceed forward with the approval process and the application process, or if they just say no, then there's no sense in everybody wasting their time. But I'm almost sure that we have then, okay, I'm getting a note right here. It says the pacemaker alone is not likely to make a life insurance company deny you a policy. In fact, it could increase your chances of getting a policy.
Absolutely.
If you were simply living with a neglected heart issue. However, it is still up to a life insurance company whether or not to underwrite a life insurance policy for you. And this came from a source on April 8th, 2020. So anyway, my staff heard the question and they Googled it, and there's your answer. Hey, I learned something today.
Awesome. And you also too, a lot of people get stents, and I can tell you right off the bat, stents are the same thing he just said about a pacemaker. They're not a denial. They're actually looked at as favorable if somebody has issues and they get the stents. It's just, if you just got a stent, they're going to want to see some track history. Brent, I love this question. And I'm going to kill two questions with one, because they're basically the same thing. So Will has a great question. He says, excuse me, if people have a lump sum of money now, but they're not sure if they're going to have regular money, for premium deposits in the future, how should they determine their policy amount to get? And then David asked, can this benefit a 62-year-old? I love this question because people think age matters, with an upfront lump sum start. So I think these are both very similar questions and very easy to answer in the same question.
Okay. All right. So anyway, I'll take it. So as far as the 62-year-old, yes, absolutely. The 62-year-old can get a policy. Normally the age is right about 73, 74, somewhere in there. So if you're starting at 73 or 74, right, just starting the policy, then that's probably about the cap on the age. Now, of course, it determines some health issues can come into play just okay, as far as that. But remember, the thing is, we have people that own policies that are in their 80s and 90s and started in their 80s and 90s. They are just not the insured individual. They're the owner. It's their money. They just insured someone else. Okay. And then the, let's see about, the premium. Okay. The premium that you put in the policy. Well, okay, so just remember the way the policy is structured is that I'm hoping, or I'm just telling you guys that the amount of premium that you choose, let's plan on paying that for at least a minimum of 4 years. So for example, let's say you tell me you want to start a policy for $10,000 of annual premium, okay? And I'm going to say, okay, Bob, we want to pay premium $10,000 a year for 4 years, right? That's what we want to do. But if you have to drop the premium, if you really have to, then you can drop it by at least 60%. So the $10,000 now becomes a premium of $4,000. All right. So, and also remember when you pay the premium, it doesn't matter what mode you pay it in. You can pay it monthly, quarterly, annually, or twice a year. Okay. So, and the thing you can do is change that mode. Just because you start one way doesn't mean that's the way you have to always pay the premium. Now, I will tell you that our clients generally do not stop paying premium or lower their premium unless they get into some financial catastrophe or disaster. And if they do, it's generally within the first 2.5 years, because once you get these things into the third year and beyond, the cash that you're getting is pretty much close to equal than what you were putting in for that year. The fourth year, fifth year, and they just keep getting bigger, and the growth keeps getting bigger. So generally, if a person is going to stop their policy, okay, in other words, kill it, or they're going to lower the premium, they're going to do it in those first 2.5 years. And then also remember, you can always change the mode, the monthly, quarterly, annually. And then to kind of get back to that other question we answered earlier, well, if for some reason that you needed money to pay the premium on your existing policy, you could always put your policy up for collateral and take a loan, even from a conventional bank, right? If you put your policy up for collateral, or how about if you have cash value in that existing policy? Could you take the cash value out of the policy? Could you borrow from the policy to pay premium on that policy? Yeah, you absolutely could, right? Because you can do anything you want with the money that you borrow from the insurance company. So there's a lot of different scenarios and equations that, okay, that can be structured. And the thing that I suggest is just get with your financial mentor, your money multiplier mentor, whoever you're working with, and go through the different possibilities and scenarios based on what's going on, like specifically in your situation.
Now, this is a good one too, and kind of a silly one, but you know, it's coming up more and more. And actually, I just posted, and you posted it as well, a podcast from the gentleman at the Nelson Nash Institute. So this was kind of very similar to this. It says, what happens if there's a run on the banks and and you can no longer access your bank accounts or cash checks? Do we still have access to our money from the policies? I'll take that one, and you can second that. The answer is yes. I mean, your money's in the insurance company, not the bank. So therefore, your money's protected. This is why the Rockefellers and all the wealthy people that you know of, why they use this system. It's why banks use this system. It's why, you know, corporations use this system. It's a different diversification to protect your money. Having it held at large, mutually owned insurance companies certainly would protect you in the event of that. Now, one of the questions came up to somebody is they said, well, what happens if the dollar gets completely devalued because these policies are basically, you know, using the US dollar? Look, that's an interesting question. I don't think it's something we're going to have to worry about. I know they're printing a lot of money, but I still don't see the dollar being worthless and us having to use wheelbarrows full of cash to the grocery store to get bread. But hey, worst case, the doomsday look, if it happened, we'd have much bigger problems to solve if that was the situation. But your money is definitely not being held at the bank. So therefore, if they closed the banks down, couldn't cash your check, your money's still at the insurance company. So you just have to find a way to get the money from them to you, and that would be it. So I don't know if you want to say anything on that.
No, I mean, I think you're right. And probably the only thing that I would add is that, okay, the people that are keeping their money in banks right now, in a conventional bank, because I'll tell you, so me personally, I keep about 2 months worth of overhead for my lifestyle in a conventional bank. If I get any more money than that, I'm sending that money back to the policy. I'm sending it back to the insurance company, right? I don't want the bank holding on to any more of my money that they need to. I mean, I'm using that banking function for the conventional bank for the convenience of online banking and being able to write checks. As a matter of fact, if like everybody made a run to the bank today to get their money, if everybody went at the same time to get their money, how much do you think they'd get out? It would be 8 or 9 cents of every dollar that they have in there. So you wouldn't get your money out. All that FDIC crap that you hear about would be out the window, right? So that's because banks, conventional banks, can loan $8, $10, $12 for every dollar that they have on hand. So just try it. I mean, everybody goes to get their money. There's not enough money there to actually get out. Have you ever went to a bank to try to get, a larger amount of money? You have to make an appointment and you have to come back. And when you want the money, they ask you, why do you want it? What do you mean, why do I want it? It's my money. You didn't ask why I was put it in here, right? You've been taking my deposits. Now I want to get it out. You got to sign paperwork, all this stuff with whoever they give it to. You got to, and again, I don't know if this is true or not, but I heard you had to give your fingerprints as well to get your money out of the bank. What kind of crap is that? But yeah, so I don't think there's any place, there's no safer place to store your wealth other than inside of a whole life policy in a mutual company that pays dividends. It's a place to store your wealth. Remember, okay, all your wealth has to reside somewhere. It's either going to reside in the conventional bank of New York, the conventional bank of Florida, or the bank of Chris Naugle, i.e. your policy, the bank of Brent Kessler, i.e. your policy. So if you have a choice to store money, where would you like to store that money? Hopefully in your own bank, where you're making the profits and the dividends and not the stockholders of the conventional bank, because it's a mutually owned company. So you share in the profits and the dividends.
Absolutely. This is what people, when they learn about the FDIC and how unsecured their money actually is at the bank, this is usually what people say. A little something like that. So you got to get knowledge. So let's see. I think this one was Taylor. I'm 54. You're the perfect age for this. Literally, we do this a ton for people in their 50s.
Well,
Tina,
I'm almost 53. So
there you go. Tina's got a great question, which I'm going to handle in a second because it's going to take a little bit longer. But right here, I got one question. It says, since I'm new, I haven't watched the other recordings yet, and I'm not sure exactly what we're doing here. However, I feel like we're basically buying life insurance for our kids as soon as possible, but my kids are 12 and 10 now. Is it too late? And if not, any policy good for their age? So number one thing to that question, I would say, is we got to get you to watch the video. So we're going to send you an email with the video. Watch it, and it will absolutely explain what we're talking about, because you kind of got the bases, but absolutely missing the main thing. We're talking about you getting back control of your money. We're talking about you creating a banking system using mutually owned insurance companies and a specially designed whole life policy to do that for you. It's far more than just buying a life insurance policy on your kids and picking which policy is best. These are very specially designed. You haven't seen one like this before. And if you have, pat yourself on the back, because you are literally probably one of the 1% that actually has seen this before, because so few people have. They think they have, But, you know, that's what Will Rogers says. Will Rogers says the biggest problem in America is not what people don't know. It's what they think they know that just ain't so. So I really want to make sure you watch that video, and we'll really help you understand it. You're coming in at the sixth week of a 6-week series. So you are a little behind, but don't worry about it. We'll bring you up to speed and we'll teach you exactly how this works. Let's see this one, Melinda.
Hey, Chris. Hey,
Yeah.
Chris. So can you take that question from Tina? You see that? Talk about how to utilize the IRA 401k to fund policies, especially since we can take out 100k. That's penalty free, right?
I can absolutely do that one. So Tina, let's get yours out of the way here. And then I got a bunch over on the Q&A. They're loading up. I love this. Hopefully we get one question that we've never heard before. So Tina's asking, talk about how to utilize an IRA or a 401k to fund policies, especially now since you can take $100,000 out penalty-free right now. Now, let's define penalty-free. Penalty-free means if you have a COVID-related event that happened, if you qualify for a COVID-related event, you're unemployed, you're having hardship, if you can prove hardship because of this event, which most every one of us can, you have the ability to take from your 401k or your IRAs $100,000 out as a withdrawal. Now, hold on before you guys get excited. You have the ability to take it out and not pay the early withdrawal penalty, which is 10%. Normally, if you take a withdrawal prior to 59.5, you have to pay an IRS penalty of 10%. The government has said in the CARES Act, which I have right here, that they will allow you to not have to pay that 10% IRS penalty if it's a allowable COVID hardship. So with that being said, we know we now can use $100,000 from our retirement accounts. Now that does not say that you don't have to pay tax on that money. So if you take $100,000 out of your IRA or 401k, you must also understand that you are going to owe all of the taxes on that. Plus, you're also going to take money from your retirement, which could have been used. But if you have to pay taxes and you're in a 30% tax bracket, please consult your CPA or your tax professional for the actual number of what your taxes are. But if you were in a 30% tax bracket, you'd owe $30,000. You're going to have to pay those taxes, and it's going to depend on your severity of your thing. And I don't have the rules. Your CPA will. Maybe 1 year to 3 years, you got to pay that. Can you use the banking policy to pay those taxes? Oh, you're darn right, you certainly can. So if you took that withdrawal from your IRA because you're just sick and tired of giving up control of your money and you want control back, and you did that, just be aware you must consult with your CPA to make sure that that's going to make sense. You must make sure how soon you have to pay those taxes back, and then we would design your map to show you exactly how to pay those taxes back using the banking policy. The second thing is 401ks, my favorite thing to talk about. 401ks, you can also now, because of the CARES Act, take out $100,000 in the form of a loan. So what happens when you take money from your 401k in a loan? Well, first off, you have to still be working at the company. If you're not working there anymore, you can't take a loan from your 401k unless you have a solo K. I'm not going to get into that today. But if you have a 401k and you're still working for that employer and you think you're going to continue working for that employer into the future and you took a loan from your 401k, you're going to have to pay that loan back. And you're going to have to pay that loan back with interest. But the beautiful thing is all of the interest you pay that loan back, that you pay on that loan, goes back into your account. So right now, are any of you making 5% on your 401k investments? Most people would say no, because the markets are going down, right? Well, they're bouncing around, but they're going down as a general trend. So if you took a loan and you paid it back at 5%, isn't that better than what you're doing now? 5% certainly better than losing. 5% is better than making nothing. So that is a good strategy. But again, caution to the wind. Consult with your CPA. Make sure that you understand that if you lose your job or you quit your job, that loan becomes taxable, all of it, just so you know that. So those are some things to do, but I think that's a great question. Tons of people asking us about it. Obviously, if it's right for your circumstance, if your needs and your goals make sense for doing exactly what we just said, taking a loan or taking a withdrawal to start your banking policies, giddy up and get on the horse and kick it hard. If it doesn't, and you're worried about the taxes, you're worried about the security of your job, maybe that's not a good strategy, and you got to be very careful with that. So
Yeah, very good. Awesome, Chris. Let me take this one it says from Leroy. Is it possible to structure a policy that has a liquid account for purposes of borrowing and another portion that ties to the market or mutual fund?
talking about a VUL.
Gold, right? So the quick answer is no. I wouldn't structure a policy that way because I would never buy an IUL and I would never sell an IUL.
Or a VUL, they're even worse.
Right. But, just with that just being said, that's a whole nother discussion. But let me just tell you about the policy for the banking concept, what Nelson Nash talks about and is exactly what we teach. All we do are whole life policies and mutual companies that pay dividends. If you ever look at an illustration, and I'm about to do a call with somebody today that is asking me, and I'm going to get on the call with that potential client and also the IUL person that he's talking to. And I said, great, I want to do the call. I'm the one that said, hey, so, right, let's get your IUL guy on the call and let's go through why to use a whole life and not an IUL, because you want to do the banking concept. But I said, before I do the call, I said, I need to see the illustration. I want to see the illustration that they're showing you. Here's our illustration. And he sent me the illustration, but guess what he did? It was a 30-page illustration and he only sent 2 pages.
It's because it's all disclosures about fees and it won't probably happen.
2 pages. So I was a little upset and I emailed him back and I said, hey, dude, you only sent me 2 pages of this illustration. Why did you leave the other ones out? And he said, well, that's all they sent me. And I said, well, these are the only pages I don't need to see.
That's illegal.
I said, I need to see the other 28 pages. I said, so do you think that there's something going on there that they didn't show you the other 28 pages? I mean, did that, right? I mean, is there something going on? Why don't they want you to see the complete illustration? Because the thing you have to do, okay, is that you have to look at the guaranteed side column of the illustrations, right? Even in a whole life, you got to look at the guaranteed. Even though the non-guaranteed is just in a whole life is going to happen or close to it, maybe a little better, a little worse, because the companies have been paying dividends for 100 consecutive years plus without fail. Every company, Chris, that both Chris and I write with, has been paying dividends for 100 plus consecutive years without fail, with the exception of Ohio National, that's been paying dividends for 97 consecutive years, right? So chances are, in the whole life policy, it's going to perform as the non-guaranteed side. But in an IUL, see, the thing that you're doing is it's dependent on other factors, such as the market and what's going on in the market, right? And if you look at the guaranteed side of an illustration, and if you look at it when the person gets to their mid-60s, late 60s, early 70s, what happens to the cash value and the death benefit? They continue to decrease. And it could be zero. That's right. It could be zero. So all the money that you put into that policy, you could have zero cash and zero death benefit. Now, how exciting is that to have happen? And not to mention the fees and the charges that they charge you. And so, but here's what the IUL guy will say. The IUL guy say, well, that doesn't happen with our company.
Yes, it does.
Well, I just went and I just pulled up about 5 or 6 different articles on IULs and what's going on with IULs and stuff.
They're being looked at by the entire.
Exactly.
Go ahead. It's
So
bad.
So if you want that information that I just pulled up this week, I think it was what's today, Wednesday? It was yesterday, or I guess maybe it was the end of last week. I don't know. But I got all this information and new information about IULs that I did not even know. So here's what I'm telling you. I'm not saying IUL is bad. I'm not saying that's bad or not. Look, IUL is an investment. So here would be my recommendation. If you really want an IUL policy, buy a whole life policy in a mutual company that pays dividends, that has a guaranteed growth rate, guaranteed death benefit. That growth rate, that cash is increasing every year, guaranteed. Not my flapping gums telling you. It's guaranteed in the policy contract. And then go invest in the IUL. Invest in the IUL, right?
I would disagree with that.
That's well, no, I mean, if you really want one, but
yeah, I think you should just
whole
buy
life
stocks if you were going to do that.
So yes. Okay. So on the policy, all right, the thing you're going to do is you're going to put money into this policy and you're going to use the money. You're going to take a loan from the general fund of the insurance company. Remember, all right, so whenever you borrow your money, you're not borrowing your money out of the policy. You're simply putting your policy up for collateral and you're taking a loan from the general fund of the insurance company. So all your money is continuing to compound and grow, even though you're using it. In other words, there's no interruption of compounding or compound interest, right? So use the money to buy the things that you want to buy in life anyway. The crypto, the gold, antique cars, real estate, IULs, because all of those are investments and they come with a risk associated with it. So I would never buy an IUL and I would never sell an IUL. And and I'll just tell you, and again, I don't know this for a fact, but I bet if Nelson Nash knew somebody
He would have
was going through and teaching the concept that he has so graciously and gifted us with this knowledge, if Nelson Nash knew that one of the agents were talking about infinite banking and an IUL in the same sentence, he'd be rolling over in his grave right now.
He would have died earlier. Are you kidding me? It would have been a terrible, terrible thing because that would have drove him nuts. Because so IULs, and we could do a whole thing on IULs, which we're not going to, but let me just show you this, folks. I like to draw. This is a great strategy. You want to buy stocks. You want something that's going to give you the benefits, what we're talking about, and you still want the upside of the market. Great. Me and Laura yesterday were just having this conversation on how great of a strategy it is. So Laura prompted me to do this. So why not set up your specially designed banking policy with a mutually owned insurance company like we're talking about, okay, your whole life? You build it up, you know you're going to make 4% guaranteed plus dividends. So with the company like Mass Mutual, I like using them because I can just use their full thing, 6.2%. So 4 plus 2.2, you're making 6.2. You take a loan out, sure, you got to pay interest to the insurance company of 5% for that loan. Oh, darn, you're making 1.2% for taking your money out. That doesn't suck. You take the loan, you put the loan in your brokerage account. I don't care if it's TD Ameritrade, Scottrade, well, Scottrade's gone. Whatever, any of them, Robinhood, and you buy some stocks, okay? You learn a thing or two about buying some stocks. Maybe you buy some ETFs. Then what you do is you take your gains and your dividends. Maybe your dividends come out quarterly and you got your gains and you sweep those off of your account, your brokerage account automatically. And then you use that and you recapture the dividends and the gains back into your cash value to repay this loan that you took out. And then what do? You repeat the process. You rinse and you repeat. And you just keep doing this. You just keep doing it and you just keep taking money out, putting money in your brokerage, take the gains and the dividends, and you just keep rolling it back in. You know what's so cool about that strategy? Do you realize your money never, ever, ever stopped earning interest and dividends? Albert Einstein says that uninterrupted compound interest is the greatest thing in the financial world. He calls it the eighth wonder of the world because this money never stopped working for you. This never worked for you, but you weren't happy making 4%. You wanted those stocks, which is why you're looking at these dumb IULs, which are burdened in fees, which are being looked at on a negative way by the overall governing bodies. Companies like New York Life, Mass Mutual, Northwestern Mutual, they don't even sell them. They forbid their agents from selling IULs. I wonder why the biggest mutually owned insurance companies forbid their agents from selling IULs. Could it be because there is an underlying problem? And folks, if you don't believe me, you just wait and watch because there's a big problem with IULs. But now you want the gains, just move the money, buy some stocks, buy some ETFs, and then play this whole game that we're teaching you how to do and be the bank and move your money. Like freaking awesome. But IULs, they're the hottest thing on the street right now with brokerages and with all the guys out there slinging them around. And maybe sometimes you just got to stop and you got to think about, I wonder why they're one of the biggest things that these guys are talking about. Could it be because they pay a high commission? Could it be because the brokerages make the most amount of money? Sometimes you just got to follow the dollar. And I just wanted to get that out. I know I went long on that. Anyway, Laura, I hope that helps. I hope anyone else that had IUL questions that got it out of the way. Let's get into some more, Brent. And I don't know how to make. Yeah.
Yeah. Anyway, I got a couple right here. This came in an email. Let me just read it. I'm just going to read it and then we'll go through and answer it. Okay. It says, I understand that I should keep a separate checking account or savings account of the monthly amount I was paying the debts. I think they're referring to the miscellaneous account.
Yep.
And then they say, how exactly is this money? How exactly this money returns just to the policy? If I want to be an honest banker and return the loan I took from the policy. And then he asked, so does this money that is deposited directly to the policy using an online banking type or process, or do I keep paying expenses and do not return the loan back? So anyway, go back and watch the presentation, my full 90-minute presentation. Chris has one too, but on mine specifically, I know exactly where it's at. So if you go to the money multiplier map, and if you look at the money multiplier map, if you notice, okay, the guy started out in the first month of the first year, he owed $470,000 of debt. And he had 12 creditors that he owed. He started his first policy with $25,000 a year in premium. He immediately took out the loan, which I think was around $14,000 and some change. He used that money to start paying down those debts. Well, so the debts that he paid off in that first month with that $14,000, now he's going to send that money back to himself. He's going to pay himself back the same amount that he was paying the creditor. So he's not working harder, changing his cash flow, taking any additional risk or losing control. He's just changing who gets the money. So in that example, in my map example, I am never paying back the loan that I borrowed from the insurance company because I have debt. I have more debt. I have 12 debts. I have $470,000 of debt. So I'm never sending that money back to the insurance company at that point. All right. The only time I would do that in that particular scenario with that map is after month 61, the 61st month, when he has all the debt paid off. Now continue to pay yourself back just like you had been paying the creditors for all that time. Okay, so take that amount that you were paying. I think in that case it's like $6,000 or $7,000 a month that was going out to other people that no longer has to go out to the other people, and now take that money and pay your loan back. Pay back the policy loan. But chances are, guess what? You're not going to do that because you're going to have other debts and expenses that comes up that you're going to use the money for. Or maybe you're in real estate, or you want to buy property. Maybe you're in cryptocurrency and want to buy gold, silver, Bitcoins. Maybe you're an antique car collector. Maybe you're investing in a new business. Who knows? A couple of you may be severely subluxated. And guys, remember, I'm a chiropractor, so the word subluxation is a hard bone irritating a soft nerve. So who knows? Maybe some of you are severely subluxated and you want to buy some IULs. You could, right? You can do whatever you want. So the money that goes back into the miscellaneous account is just money. It's kind of like a holding tank, right? And the only reason we tell you that and again, it's not required, we just recommend that you have another separate checking or savings account. So when you're paying yourself back, that money is not being commingled with your regular checking account. It's not necessary to have it separate. If you want to commingle it, you can. It's just cleaner if you don't, and your tax professional, your CPA, your accountant will like it better if you don't commingle the funds. So that was a question from Morrow that came in on an email.
Oh, thank you so much for hitting that one. We've been working real closely with him. He's got some amazing things happening, and I'm excited to be working with him. Thanks for hitting that one. How about Kathleen's here? We got Kathleen. Is there a fee you charge to help us set up our policies, and what's in it for you? Great question. Commission, flat fee, percentage, premium, all of it, Kathleen. I'm just kidding. Brent, you want to explain how we get paid and how it's in it for us?
Yeah, absolutely right.
There's no fee that they get to pay.
Yeah, that's a great question. That's a great question. And again, I know this kind of throws people off because they're thinking fees, 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 charges, charges, charges. You know, well, my Charles Schwab guy charges, Edward Jones, T. Rowe Price, right? Ameritrade, they charge me fees and charges. How much do you charge for your services? Well, here's how we get paid, okay? We get paid one way only. You are never going to write a check to Brent Kessler, Chris Naugle, or the Money Multiplier. You will never, ever, ever write us a check. We get paid the same way your car insurance guy gets paid. So when you go to John Smith, the Allstate man, to buy car insurance, the check that you write is not to John Smith. The check that you write is to Allstate, and then Allstate pays John Smith a commission. So we get paid a commission on the policy that you start. Now your question is, oh, okay, you guys get paid a commission. Well, I know my broke-ass brother-in-law sells life insurance, and I would like to help them out, right? So why don't I go buy a policy from them? Well, here's why you want to use us and not the guy down the street that sells life insurance. The reason is because we understand the banking concept. This is all that we do. We're a 100% this concept and this method that we teach you. We don't do anything else. Well, some people might say, well, my guy down the street, he can do annuities and IULs and whole life, and he can do all kind of different stuff, right? He can put my money under management. Well, not us. We do one thing only, and this infinite banking concept is what we do. Let me ask you this. Let's say you had a problem with your heart, okay? Are you going to go to the general practitioner for the problem with your heart, or are you going to go to the cardiologist, the heart surgeon? That's right. You're going to go to the heart specialist. We are the specialist in this concept, all right? That's why you want to use us. Now, let's say your other guy says, well, I know all about this R. Nelson Nash book, Becoming Your Own Banker. And I've heard of that book, and I know all about it, right? Well, here's the first thing I would ask them if they know about it. The first question is to ask them, well, if you know about it, why haven't you told me already? Why am I asking you about it? That'd be the first question. And then here's a way to really find out if they really, really, really know and understand. Ask them 3 questions. Ask them to show you how you're going to borrow at a higher rate than what you're earning to make money all day long. They don't know. They're not going to show you. I show you that in the present. Okay, so I showed you that in my presentation. Number 2, ask them how you're going to be able to buy a car and recapture and recycle and get all of the money back for the car. So not only do you get the car, but you get the money back. They're not going to know. And number 3, have them create you your own specific money multiplier map with your debts and expenses in it. Ask them to do that for you. They're not going to know. They don't understand. And if they do, let's just say they do all of those things, they're going to be very hesitant and skeptical to design your policy for this process, for this method, for this concept. Because in order for us to design your policy this way to where you have high immediate cash value, Chris and I have to take at least a 60% cut in our commission in order to design your policy this way. And they're not willing to do it. The other agents are not willing to do it.
Oh, that's
so that's
for sure.
why you want to work with us.
Yeah, there's so many awesome questions coming in here. Let me get this one answered here. Your premium deposits, then it's on your full cash value. Sorry, folks, I'm typing these questions in and also doing this, but let's do this one. Let's see. That was that one. So we answered that. All right, let's do this one. Cassandra, I'm waiting on approval of my policy, planning a $500 a month premium. Question about doing a large lump sum deposit at the beginning. I'm selling my house and expect to get between 160 to 200 for the sale. I have 30K in credit card debt. Actually, I think I have a call set up with you, Cassandra. I can't wait for this call. Would I pay off the credit cards from the cash of the sale, or do a lump sum deposit and pay off the credit cards and then pay myself back through the policy? That's a super easy one. You want that one? So essentially she's wondering, should she do a large lump sum deposit into the policy, use that money from the lump sum deposit to pay off her credit cards, and then pay herself back for the, for paying what she was given the credit cards, or should she take the cash from the sale of her house, pay off the credit cards, and be done with it that way? It's
Yeah.
a simple answer.
Well, yeah, and I'm probably going to complicate it more, and then I'll let you do the simple version. That's how we usually work, right?
Yeah.
But anyway, here's my thought. Always try to get money into the policy first and then pay the debts and expenses, because now you're able to recycle and recapture those dollars, right? But again, there has to be more to the equation. Like, how much can we get in the policy? How much is your premium going to be? How much of a lump sum can we put in first, right? Because I got to make sure you can still continue to put premium into the policy. So even though in some instances you may pay more interest by putting the money in the policy first. So like, does it really matter if you pay a little bit more interest to the creditors if you know you're going to recycle and recapture all of the money anyway? And the answer is no. Remember, this isn't the short-term play. This is not the sprint. It's a marathon. So my answer is, it depends what your situation is, but as long as you can get money into the policy first and then pay the creditors and pay yourself back, just like you were paying them, play honest banker, that is always going to be the better play long term. And everything we talk about is long term. This is not a sprint. If any of you are on this call or this webinar and you're thinking short term, go read the book called A Purpose-Driven Life by Rick Warren. Life is like a marathon. It doesn't matter where you start. It only matters how you finish. This is the game of life. So if you're thinking short term, I would hang up the phone, close your computer, and go eat some lunch, right? Because you're just not gonna. You're not gonna be happy. So it's not a quick, instant thing. So use the policy for the debts and expenses that you have anyway. Try to get the money in the policy first if you can, and then pay the debts and expenses. The last thing I'll say to this is, a lot of people ask that when we create your money multiplier map, why are we going from the lowest debt to the highest debt and not the lowest interest rate to the highest interest rate? Because we want to get the cash flow rolling, right? We're rolling the boulder up the hill and we want to get it to the top so it comes down and it's easier to, again, it's going to just, go a lot quicker if it's coming downhill instead of uphill. So yes, I get it. You may pay some more interest by doing it that way, but at the end of the day, it doesn't matter when it all comes back to you anyway. You're going to recycle and recapture it all, just like in the teachings with our examples that we show. And the last thing I'll say on this, and I know the last time I said it was the last thing, but just on this, Chris, is that the policies are guaranteed to grow. You have a guaranteed cash value growth in the policy. And the more you use the policy for the things that you're going to buy in life anyway, the bigger the numbers get. And for a refresher on that, go look at the Nelson Nash book right here, Becoming Your Own Banker. We talked about this. This is all right, there's Nelson, the Mac Daddy, the godfather, the mentor, the creator of this concept. And go look at page 54, 59, 60, 61, and 62. It's all the same example, but as you go up in pages, so the example, so like it has him just on page 62, it shows you where he's using more of the products and services. He's using this policy for more of the equipment compared to page 54. So the more you use it, the bigger the numbers get. And that's what we should do. And that's going to make the policy most efficient and effective.
Yep. This is a good question here from Matthew. So Matthew says, does it make more sense to pay the policy loan back as soon as possible, recapture with interest? For example, you take out a policy loan to pay off 6 months worth of bills. Then you earn the money plus interest back by month 3. For example, loan amount plus added interest. Would it be better to put that money immediately back into the policy month 3 or continue to keep it in the bank account?
Okay.
So he's kind of talking about that segregated account. Would it make more sense to keep it in the segregated account or get it back in the policy? I mean, I'll let
Right.
I'll let
Well,
you handle that one, and then
so
I'll do
let
it.
me explain the thing that I would do. And again, okay, so please note that whenever you watch my presentation on the money multiplier map, so the thing that we do is just take the loan, we pay off debts, and then we're paying ourselves back into that segregated account. And then, so the way I show it in my example is I'm not going, okay, just back to get the money out of the segregated for 12 months, for a year. In real life, we're never going to wait a year to get the segregated money out. The reason I show it that way on the map is because it's for educational purposes, and I would have 9 million numbers on that sheet, on that money multiplier map, and it would be very confusing. So really what you want to do is, just like we talk, you want to continue to keep the money in motion. Keep it in motion. So when you're paying yourself back now the next month, or maybe a couple months, okay, or yeah, maybe 1 or maybe 2 months, now take that money you were paying yourself back and send it back to the next creditor or the next debtor. So keep it going. Don't let it stack up for a year, okay? The only time I send money back to my policy is when I know that I'm not going to need it for more than 120 days. That's just kind of my rule of thumb. And again, I'm not saying it's wrong or right if you do it in 90 or 180, but if I'm going to need to use that money within, say, the next 4 months, 120 days, then I'm not sending it back to the policy, because I'm just going to be requesting again to have them to send it back to me. Pay it back, have them send it back. Pay it back, have them send it back. So now all we're doing is playing mental gymnastics with the insurance company. So that's kind of my rule, is about 120 days. If I'm going to need it, just, okay, between now, okay, and the next 120 days, I'm going to keep it in my account because I know I'm going to use it.
Brent, how long have you been in the business now?
I started my first policy, let's see, back in 2006 is when I first heard about this concept. I thought it was too good to be true. And about, 10 or 12 of my colleagues that were actually, I was at a chiropractic convention when I first heard the information. About 10 or 12 of my colleagues that were at the same convention, right? So they started it as soon as they heard it, and I didn't. I went back to another chiropractic convention in 2008. They were going on and on about paying off debt, recapturing money, recycling. They had complete control. They didn't have to work any harder. They didn't have to take any additional risk or lose control or change their cash flow. And they were going on and on about how they were doing this. And I thought to myself, there had to be something to this. So I came home and I told my wife, I said, we got to start doing this. We got to start implementing this in our life. And because I thought, man, there's no way 10 or 12 of my colleagues are lying to me, maybe 1 or 2, but not 10 or 12. So we started our first policy in February of 2008.
Oh, I was off a year.
That's when I started my first policy as a customer. And I got licensed in March of 2012, I believe, March of 2012 as a licensed agent. And now I work with clients in every state of the country. I'm licensed in every state. Up until 3 weeks ago, I was not licensed in the state of Maine because I didn't have a client in the state of Maine. And we got a client about 3 weeks ago in the state of Maine. So now I'm licensed and I have at least one client in every single state of the country.
Awesome. All right. So Glenn is asking, can you recap infinite compound interest?
I'm sorry, say it one more time.
Yeah, Glenn is saying, can you recap infinite compound interest? So he's probably talking about uninterrupted compound interest, what that means.
All right. Well, yeah. Okay. So anyway, in the policy, the thing that you do is, okay, so like pay premium into the policy. And when you put that premium into the policy, the insurance company takes your money that you put in there, and what they're going to do is they're going to use that money. For example, about 80% of their portfolio is in investment grade bonds. About 7% of their portfolio is in home loans, all right, like home mortgages. Another 7% is policy loans to their policy holders, and the other 7% is in cash. because they have to have cash on hand when death occurs. All right. Unlike just fractional reserve banking. See, a bank can loan $8, $10, or $12 for every dollar they have on hand. In the banking concept, you cannot do that, right? $1 has to protect $1. So go back and review Austrian economics. $1 has to protect $1. And this is a mutual owned insurance company, and you are the owner. There's no stockholders of your policy. You are the owner of the policy, so you have first right to your money. So when you want the money, you have first right. And what you're going to do is you're going to put your policy up for collateral, take a loan from the general fund of the insurance company. So you're not borrowing your money out of the policy. You're putting your policy up for collateral, taking a loan from the general fund of the insurance company. So what does that mean? That means that your money in the policy is still continuing to compound and grow at that guaranteed tax-free growth rate, growing internally, and the government's out of your hair. So there's no interruption of the compounding effect. You don't interrupt that. Have you ever seen a calendar or a chart of what happens if you take a penny and you double it every day for a month? And right, so what happens every day you double the penny, how much money that you would have? Well, it's over, let's see, I think it's 10 million if it's a month that has 31 days, and 5 million in a month that has like 30 days, right? Well, here's why that's important. Because let's say you put that penny in there and you put it in and it's doubling every day, but in the 12th day you pull it out. Oh, the penny's gone. And now you wait a day and you put it back in on day or 13 or 14. Well, how much did you put in? You put in a penny. So now that cycle starts all over again. So now the penny starts at the compound on the 14th day because you pulled it out in the 12th day, right? So you interrupted the compounded growth of that penny. And that's the cool thing about the policy, is that when you take a loan, you don't interrupt that at all. You don't interrupt that compounding effect because your money is still continuing to compound and grow even though you're using the money.
Absolutely. All right. So this is a longer one. So I'll read this and then we can kind of just break it down. How would I get retirement money into multiple policies from retirement money that I will be getting from a state qualified investment plan? Kind of need clarification on that. Whoever's question is, do you mean taking withdrawals for retirement dollars, like your distribution, or do you mean just like taking money out based on the CARES Act or loans? That's the first thing we'll need to know. What is the max amount we can put into a policy? I can answer that. $1 million a year right now is the max. Will I have to pay taxes on the money before I fund the policy? Yes, you will. And what is the best way to get the money over to policies? We don't want it in banks. Take it directly from, well, we might have to make a pit stop and fuel up at the bank. In other words, go from your retirement account to your bank account, then from your bank account to your banking policy. We will need to stop it there because then you'll just basically do an EFT or a ETF into the banking policy. But the first one, do you want to hit that one, Brent? About retirement dollars, or it's kind of, we need a little more info.
Yeah. Let's see. I got to pull the question up because I wasn't paying 100% attention to you.
Yeah, he's saying, how do we get retirement money into multiple policies from retirement money that I will be getting? So it sounds like he's getting distributions because he's getting money from a state qualified plan.
Okay. So let me just say this. Everything we talk about is with after-tax dollars. We're not rolling money from a qualified plan into a policy. What we're assuming, everything that we're talking about, is that money is out of that plan and you pay tax on the money. We're talking after-tax dollars. And if you really think about it, that's really the thing you want to do with your money. The thing you want to do is pay tax on your money one time only, okay, at the lowest rate possible. And you want to get that money into a tax-free environment where it's growing tax-free, and you want the government out of your hair. So yeah, after-tax dollars is the thing that you want to do. And again, I'll go back to the 3 questions and go back to our previous sessions. Is $1 worth more today or in the future? It's worth more today, right? And if you forget that, think about how many candy bars you could buy 20 years ago for $1, how many you can buy today. Question number 2, are taxes going to go up or go down? That's right, they're going to go up. That's the history. And what's going to happen now with all the crap that's going on? Who's going to pay for all this crap, right? So you know taxes are going to go up. And number 3, number 3, would you rather pay tax on the small amount of the seed or the large amount of the harvest? And hopefully you're saying the seed. Well, all 3 of those answers, when you put money in a 401k, IRA qualified plan, you're violating those answers because you're giving up good dollars today to get paid with non-guaranteed weaker dollars in the future. You're compounding the tax because the tax is always going to be there. And when you do pay the tax, you're going to pay it at the higher rate and not the lower rate. So go back and review my presentation and I go into that. Okay, is that it, Chris? What's next?
And then he was saying he is retiring, so that we were correct with that, and he's getting a lump sum from his pension. I'm very familiar with that. So he's taking a lump sum pension. He has the ability to then take that lump sum, roll it into an IRA and take distributions, or he could just take the lump sum, pay the taxes, tear the Band-Aid off, pay tax on the seed, not the harvest. It's sort of the harvest, but still it's going to be more. So I don't know your name because it just comes up with your number. I would love to set up a call with you. So any of you that have questions like that we really can't get the specifics out here, the best thing you can do is set up a call with us. When we do a call with you, we're just going to answer questions, and I'd love to take your call. So if you could text Chris to 33777. Actually, I'm going to send that to you. So you want to text Chris to 33777 because that is my specialty with it. And if you want to talk to Brent, you would just text Brent to 33777. And what that's going to do is give you our calendar, and then you can pick a day that works for you. But with retirement questions like that, there's a lot of moving parts. I'd love to help you. I'd love to really kind of dive into that and make sure it's the right thing for you to do. And if it is, then you'll be able to make the right decision as to whether this system will work for you with your retirement dollars and exactly how we do it. And I'm pretty certain it will. Chris is asking, and Chris is one of your clients, Brent. So I did fund it over $10,000. Should I stop? Oh, so he's talking about the MEC. He's got like a 2-part. So he was set up and approved for $10,000. And he says that he did fund it over 10,000. He's worried that the plan is going to MEC. So should I stop and just pay the 10,000 from this point on? Yeah, well, that would be probably the way to answer that, but I'll let you take that one.
No, Chris. Okay, so the way the policy is set up is it's not going to MEC. When we set these policies up, the policy will not MEC. And so like even if you try to MEC the policy, the insurance company is going to make you sign documents just saying, hey, you're about to MEC this policy. And the way it was set up is so it is not going to become a MEC. And as a matter of fact, they'll send you the check back, or they'll send you the difference back that you've overpaid. So like in the beginning stages of the policy, sometimes people do what they call a dump in into the policy. So for example, if your premium is $10,000 annually, a lot of times in the first year, they'll want to max that policy out in the first year and maybe put an extra $3,000 or $4,000 in, depending on the premium amount and depending on what we call the 7-pay MEC test is. You can get extra money into the policy. So the way that your policy is designed, Chris, I would, and again, I'm assuming you're putting in $10,000 of annual premium. Yeah, that's fine. Continue to put in the $10,000 of annual premium. And if there's ever a time that you want to see if the policy will hold more, then the call just needs to be to the insurance company, and they will tell you how much more money that policy will hold without it becoming a MEC. But that answer is different for everybody. It's different at different times and days because of what's going on inside of your policy. So probably it's going to be much better for you to start a second policy if you want to add more premium into the policy, unless it's just a small amount and you're only looking to do it as a one-time, like a one-time dump. But normally the one-time dump-ins are done in the first year of the policy, or even right initially when you're starting the policy in the beginning.
Correct. Yeah, so that was a great way to answer that. And then I don't know, did you answer the one question? It says, how is the process to put back the money we take as a loan back to the policy? How to be an honest banker in a practical way? How to deposit back to the loan to the policy? I mean, we create that map for you.
Yeah,
And
the
we're
map
gonna,
is
yeah, the map
created.
is we're going to create.
Give you the directions of what to do and how to do it. And our team, that's what makes us unique. You have a full team here that's going to service you. So again, in that map example, the money multiplier map, it's going to lay out exactly what you should be doing inside of the policy in that map, that money multiplier map. And the map that we create for you, it's just not one map. Remember, those maps are being created for you 2 to 3 times a year. I like to say every 4 months, 3 maps a year, because where you're at today financially is not going to be where you're at a year from now, 5 years, or 10 years from now. And it's not where you were 1, 5, and 10 years ago, because you're going to go through life. You're going to buy things, sell things, windfalls, downfalls, raises, demotions. Your financial life is going to change. So as it's changing, we're going to update that map for you. So that's why I don't think there's anybody on the planet that does this. And I have some friends and colleagues that are doing what Chris and I do. I don't think they do it as well. That's between us, right? But I don't think there's anyone on the planet that offers the service and what we do to our clients. And I tell people all the time, I say, I've been doing this for a long time, have over 2,000 plus clients of my own in every state of the country. And I don't know anybody that's mad at me. I don't know anybody. And if there is someone, they haven't told me they're mad. So that's the cool thing about this, is people don't get mad at you when you're helping them create multi-generational wealth.
That's for sure. That's a great way. And you know what? The funniest part about this, Brent, we knew this was going to be a good one, and we literally answered every question. I didn't think we were going to get through them all, but we did. Well, no, this is just on the Q&A. 47 questions answered, plus all the chatted in questions. Like, talk about a success. I mean, we knocked that out in an hour and a half. And you know, the also most impressive thing is we obviously must be doing something right, because we had like 89 people at the very beginning of this, and we had 80 people when we finished. Like, we only lost 9 people, and it's probably because they all had to go to the bathroom and they didn't come back. I mean, hey, this is pretty impressive stuff. And, you know, like you said, changing people's lives is a pretty important job. And, you know, we take it very serious. And, you know, based on some of the, you know, a lot of people get here from different ways, maybe duck via webinar, maybe the email blast, maybe you've read our book, maybe you just saw a Facebook ad or an Instagram ad and you showed up thinking, oh, they're going to try to sell me something. We're not doing it that way. We're just not, because you know what the most important thing that, you know, and I think I learned some stuff from Brent, and maybe Brent learned some stuff from me, but one of the most powerful things I think I can say is when you go out there and you do something with the intention of truly helping people, you don't have to sell anything, which we don't. We don't sell anything. I mean, if you want our help and you want us to help you set up your banking policies, we're here to help you, but you're going to have to ask us. We're going to set up a call. And if you guys want to set up a call, all you do is you text Brent to 33777. So text BRENT to 33777. It'll give you his calendar, and you just schedule a time. When you're on that call with Brent, or you can schedule a time with me, Chris, at 33777. All we're going to do is answer your questions. We're going to listen to you. We're going to take notes down for what your situation is, what your needs are, your goals are, and how do we solve your problems. And at the end of that call, it's always the same. It's, no matter whether it's me or Brent doing it, it always goes, okay, do you have any final question, or do you have any more questions? And the person on the other line says, nope, I think you answered all the questions. Great. And then pretty much there's a silence. And then they say, well, I actually do have one more question. What's the next step? How do I start? Every time, is it not, Brent? I swear it's like clockwork.
It is.
Because we're doing the right thing. You don't have to sell something to someone when you teach them how to change their financial life. They will ask you for help, because we're providing you the guidance, the way, in a secret that not many people know about. And I'm going to give you guys one more thing for everybody, all 73 people that are still on here. How about this? If you don't yet have our book, Mapping Out the Millionaire Mystery. How about we give this to you for free, folks? We will give you the book for free. Just pay for the shipping. And if you're outside the US, unfortunately, we do have to charge you an international because I got dinged with a $119 shipping fee. I sent the darn book, but that'll be the last one I send internationally. So your international shipping fee, if you're in Canada or anywhere else, is $19.95. But you get the book for free. You just pay the shipping cost. And if you guys want to do that, here's how you do it. I'll type it in the chat. So pay attention. It is moneyschoolrei.com/new book. So moneyschoolrei/new book. So if you guys want that book and you guys want it for free, you just pay the shipping. There's the link right in the chat. Grab it. We'd be happy to ship that book out to you. And every single day I'm shipping books every day. So let us know how we can be of service. You now know how to get a hold of us. Brent to 33777 or Chris to 33777, just so that it's up there because we didn't put it up at all. And we're happy to help any of you. And I don't know, Brent, anything in closing you want to say?
Yeah, well, again, it's been a great, so it's been a great day today with the questions and the answers. And again, I'm glad you guys asked the questions that you did, and I hope it really helped. And it's been a fun 6 webinar series. And I think the one thing that we learned today, if you take nothing else out of today, remember when somebody comes to you and they say, hey, I know all about that infinite banking concept, becoming your own banker. And my guy says that we're going to be able to do this with an IUL, an Index Universal Life Policy. Here's what you do. All right, man. It was fun.
That was awesome. Next week, folks. So this is the end of the 6-week series. We're going to email this out to every one of you. You all get a copy of every single recording. Next week, I'm going to do what I wasn't able to do here. I'm going to show you how I structured the plan for my new daughter, Viviana. And you're going to be surprised because you saw Larry Lucky Jeans. That was impressive. That was a plan on a 1-year-old, but my plan is not on Viviana's life. And I'll show you why and how next week, and you'll see how that thing is going to do so much, not only for me, the family, but for Viviana. And hopefully she becomes a professional surfer, and the policy will fund her entire surfing journey for the rest of her life and whatever she wants to do. Join me next week for Wealth Webinar. Same great time, same great place. We'll see you then.
See you guys. All right.